So imagine you're sitting in the cockpit of a commercial airliner, right? You look at the dashboard, and the altitude is climbing, engines are running perfectly, fuel efficiency is setting records. I mean, everything looks fantastic.
Right, a totally perfect flight on paper.
Exactly. But then you look out the window, and all the passengers are screaming, they're strapping on parachutes, and they're just jumping out the emergency exits.
Yeah, which is obviously terrifying.
Right, and that is exactly what is happening right now with one of the most recognizable tech giants on the planet. Welcome to today's deep dive. If you are the kind of learner who wants to cut through all the financial noise and, get to the actual signal, you are in the right place.
Absolutely.
Today, our mission is to unpack this massive stack of, I think it's 8 detailed financial reports from mid-2026, all centered on Adobe.
Yeah, and contrast between that internal dashboard you mentioned and the external panic, it's just jarring. I mean, the market is currently in the grip of what analysts are calling the SaaS-pocalypse.
The sauce-pocalypse.
Right. It's this widespread, almost existential dread that artificial intelligence is going to completely obliterate traditional software as a service businesses.
Yeah.
The fear is that AI will do the work faster, cheaper, and without needing those expensive monthly software subscriptions.
Which is a very real fear for investors.
Exactly. So we are looking at these reports to figure out if Adobe is the ultimate casualty of this AI revolution, or, and this is the flip side, if the market has just completely lost its mind and this is the greatest tech bargain of the decade.
Okay, let's unpack this dashboard first. Because Adobe's Q2 2026 revenue, it hit a record $6.62 billion.
Yeah, massive.
That is up 13% year over year. Their earnings per share beat expectations. I mean, they're literally making more money than ever. Yet their stock is down somewhere between, 40% to 70% from its 2021 peaks? Wall Street analysts are just running for the exits.
Yeah, they really are. And to understand the sheer scale of the discount Adobe is trading at right now, we have to look at how investors used to treat them. Historically, Adobe traded at over 30 times its free cash flow. Investors gladly paid that massive premium because Adobe was essentially an unchallenged monopoly. But today, its forward price-to-earnings ratio, or PE, is hovering between 7.4x and 9x.
Wow. Wait, really?
Yeah. That is a 60% plus discount compared to its tech peers. I mean, to put that in perspective, Microsoft is trading at around 19x. You usually see a 7x PE on a dying steel mill or a legacy automaker.
Not a high-margin software company with recurring revenue.
Exactly. Not a software giant.
And this is where the bull came. The investors who are aggressively buying the stock right now, this is where they plant their flag. They look at Adobe's fundamentals on paper, and those numbers just look bulletproof.
Oh, totally.
They boast an industry-leading 89% gross margin, and the reports also highlight an equity cash yield of over 11%.
Right, which is huge.
It is. Let's break that down for the listener for a second. Equity cash yield is basically how much free cash flow the company generates relative to its total market value. It's kind of similar to a dividend yield, but instead of just looking at the cash paid out to shareholders, it measures the raw cash-generating power of the business itself.
Yeah. And an 11% yield is almost 3 times the yield of a 10-year Treasury note right now. So the bulls run this math and argue that Adobe doesn't even need to do anything spectacular to make investors rich.
Right, just keep the lights on?
Pretty much. If
Right.
they just maintain their current 12% revenue growth and continue generating that level of cash, investors could see a 17.3% long-term annualized return, and that's without the valuation ever going back to its historical highs.
Okay, but I have to push back here. If the numbers are so undeniable and the math is really that simple, why are so many smart analysts hitting the panic button? A stock doesn't just lose half its value for no reason, right?
No, it doesn't.
Wall Street might be emotional, but it's not usually blind to a guaranteed 17% return.
And that's the multi-billion-dollar question. The analysts selling the stock, they acknowledge the top-line revenue looks great today, but they argue the underlying foundation of that revenue, Adobe's absolute monopoly in the creative space, is showing severe structural cracks.
Cracks in the foundation.
Yeah. Adobe is essentially fighting a brutal two-front war right now.
Okay, let's look at the low end of that war first. Because you have companies like Canva, CapCut, Affinity, and they are capturing this massive pool of personal users, small businesses, and students with these free, easy-to-use, browser-based template.
Yeah, the browser's key there.
Exactly. I mean, think about your own workflow recently. When was the last time you opened a really heavy, complex desktop application just to resize a photo or make a quick social media graphic?
Right, you wouldn't. You just drag it into a lightweight browser tool.
Exactly. And that shift in consumer behavior is pulling tens of millions of K-12 students and casual creators into the Canva ecosystem.
Yeah, they are learning design without ever opening Photoshop, which is a huge generational shift. And then on the high end of the market, you have Figma, which is actively pulling professional UX and UI designers away.
Right.
Figma was built from the ground up for superior cloud collaboration. It allows entire teams of designers and developers to work on the exact same file simultaneously in a browser. And Adobe's legacy architecture, which is built heavily around local desktop rendering.
Yeah, they struggle to replicate that seamless multiplayer experience.
Yeah.
It's like Adobe built this massive, incredibly expensive toll bridge that everyone absolutely had to cross if they wanted to do any sort of professional creative work.
That's a great way to put it.
But now, Canva's come along and built a free ferry for all the casual commuters. And Figma dug this high-speed, collaborative tunnel specifically for the professionals. So the toll bridge is suddenly looking a lot emptier.
It really is. And if we connect this to the bigger picture, if we look closely at the financial data in these reports, there is a crucial detail that proves your toll bridge is losing traffic.
Ooh, what is it?
So Adobe proudly announced a strong total annual recurring revenue, or ARR, of $27.1 billion. That sounds like massive healthy growth.
Right, $27 billion is nothing to sneeze at.
But the bear analysts dug into the composition of that number. That $27.1 billion includes roughly $480 million from a company Adobe recently acquired called SEMrush.
Wait, so they essentially just bought a chunk of their own growth?
They did. They bought it. If you strip out the revenue they acquired through that purchase, Adobe's organic ARR growth, the natural growth of their core products, has actually been decelerating for 10 consecutive quarters.
10 quarters, wow.
Yeah. I mean, think about it. If you own a chain of coffee shops and you buy a rival chain, your total revenue goes up. But if you look under the hood and realize your original shops are selling fewer lattes every single month, you have a major problem.
Right, because you're masking the decline.
Exactly. That 10-quarter stagnation suggests the core business is losing its pricing power and its ability to attract new users organically.
Man, so if you are Adobe and you can't rely on your old monopoly to bring in new users, you have to create a completely new moat. You need something your customers simply cannot live without. Which I guess explains the massive influx of cash we are seeing them pour into artificial intelligence.
Yes, that new moat is Firefly, their generative AI engine. And the Bull reports show that AI adoption is exploding across Adobe's ecosystem.
Right.
Their AI-first annual recurring revenue surged over 200% year over year. It crossed $500 million in Q2, with Firefly alone accounting for $300 million of that.
Here's where it gets really interesting, though. There's a very specific structural reason why Firefly is succeeding in the enterprise space where platforms like Midjourney or OpenAI struggle.
Yeah, the copyright issue.
Exactly. It all comes down to copyright. Those other platforms scrape the open internet for their training data, which has led to massive legal ambiguities and, pending lawsuits. But Adobe took a totally different path. They trained Firefly exclusively on their own massive library of licensed stock images and public domain content.
Right. And that creates a massive corporate shield for a Fortune 500 company. I mean, if you are Disney or a global ad agency, you simply cannot afford to generate an image for a worldwide marketing campaign and then face litigation because the AI secretly learned from a copyrighted artist's work.
No way. It's a huge legal risk.
Firefly gives enterprise clients that legal peace of mind. And furthermore, Adobe is rolling out what they call agentic AI. These are AI agents embedded across Photoshop, Premiere, and Illustrator that don't just generate a picture, they execute complex, multi-step workflows.
Wait, walk us through how that actually works in practice. Like, what does an agent actually do?
So instead of a designer manually cropping an image, adjusting the color balance, exporting it, and uploading it to a campaign manager, an agentic AI can receive a simple text prompt and do all of it.
Just from one prompt?
Yep. They can automatically resize a master asset into 15 different aspect ratios for various social media platforms, apply brand-specific color grading to all of them, and route them directly to an art director for approval, all without human intervention.
Okay, but let me play devil's advocate here, because this seems like a massive double-edged sword. If agentic AI can do the tedious work of 5 junior designers in 3 seconds, Don't those global ad agencies need to buy fewer Adobe subscriptions?
That is the exact fear.
Right. Because if a firm only needs one art director to manage the AI instead of a team of 5 junior designers doing all the grunt work, Adobe loses 4 paid seats. They're essentially cannibalizing their own business model.
And that cannibalization risk is the beating heart of this apocalypse narrative. But the bears also point out a secondary threat to Adobe's profitability regarding AI compute costs.
Oh, the server costs.
Exactly. To fight off all these new, cheap AI competitors like, say, Google's new Nano Banana 2 Lite, which generates images in seconds for free. Adobe is being forced to push a freemium model. They have to give away a lot of AI power for free just to get people into their ecosystem.
It was work to some extent, right? It boosted their monthly active users to, what, 850 million?
It did, but getting users isn't the same as making money off them.
Right, because the marginal cost of traditional software is practically zero. Like, once you build the code for Photoshop, letting 1 million new people download it just requires a tiny bit of server space.
But generative AI is completely different. Every single time a user clicks generate, Adobe's servers have to run billions of complex calculations on massive, incredibly expensive GPUs.
Yeah, that's not cheap.
It's essentially like paying the electricity bill for a small town just to generate a picture of a cat. You're giving the product away for free to compete with Google, but you are paying a massive utility bill every time that free product is used.
So the margins get crushed.
Exactly.
Yeah.
Bears argue this dynamic will permanently crush Adobe's pristine 89% gross margins, dragging them down toward the industry average.
Okay, so just to recap the bear case for a second. The margins are under threat by high compute costs, the organic growth is slowing down, and on top of all this, the reports mention a major leadership vacuum, right?
Yeah, a huge one.
Both the CEO and the CFO are in a state of transition or retiring. So the market is incredibly nervous about who is actually steering the ship during this massive pivot.
It's the worst possible time for a leadership shakeup.
So how does a company in this position signal to Wall Street that they have total confidence in their future? They open their wallet, they announce a staggering $25 billion stock buyback program approved all the way through 2030.
Yeah. And the bulls argue this buyback is the ultimate safety net. If you look at Adobe's current depressed valuation, spending $25 billion to buy their own stock could retire roughly 30% of their outstanding shares.
30%.
Yeah. And this artificially guarantees a return for investors, because even if the company's overall net income stays completely flat, the earnings per share, the EPS, will skyrocket.
Because that same amount of income is now being divided among 30% fewer shares.
Precisely. It puts a massive floor under the stock price.
But the bear reports, however, they just tear the math on that $25 billion buyback apart. They argue that the headline number is largely an illusion because of stock-based compensation, or SBC.
What's fascinating here is how that SBC actually works behind the scenes. To retain top talent, especially highly sought-after AI engineers, tech companies pay a significant portion of their salaries in company stock rather than cash.
Right, RSUs.
Exactly. The company issues restricted stock units, which creates brand new shares and dilutes the existing shareholder pool. And the Sources project that Adobe will issue around $8 billion in stock-based compensation over this exact same period.
Wow. So they are printing billions of dollars in new shares to hand to their employees while simultaneously spending billions in cash to buy shares back from the open market.
Yep.
So the net buyback, the actual reduction of the number of shares, isn't $25 billion, really only $17 billion. They're spending a fortune just to tread water.
Exactly.
And that brings up Adobe's track record with capital allocation. How good are they at actually spending the cash they generate?
Well, the bears have a laundry list of grievances regarding how Adobe has deployed its capital recently. I mean, Adobe spent billions buying back their own stock at record high valuations back in 2021 and 2022.
Ouch.
Yeah, effectively setting that capital on fire before the market crash. Then there was the failed attempt to buy Figma for $20 billion. That deal got blocked by regulators, and Adobe had to pay a $1 billion breakup fee for absolutely nothing in return.
$1 billion for nothing.
Nothing, and more recently, they paid a hefty premium of 4 times ARR to acquire SEMrush just to mask their slowing organic growth, like we talked about earlier.
So this massive buyback is like trying to bail out a leaky boat using a solid gold bucket. I mean, it sounds incredibly impressive to the shareholders watching from the shore, but the stock dilution from employee compensation and the history of bad acquisitions, the water is still rushing in.
It's a great analogy. And if we look at the financial definition of what's happening here, this dynamic where stock trades at a cheap valuation, but the underlying fundamentals, capital efficiency, and market share are deteriorating, that is the textbook definition of a value trap.
A value trap. So what does this all mean? We keep seeing that specific phrase pop up in the analyst reports. Can you define exactly why they are labeling Adobe a value trap?
A value trap is one of the most dangerous things in investing. It occurs when a stock looks incredibly cheap based on historical metrics. An investor looks at Adobe dropping from a 30x PE down to an 8x PE and assumes they are getting a bargain.
Right, it looks like a sale.
But a value trap means the stock isn't actually cheap. It is simply priced correctly for a new, grim reality. The bears believe Adobe's era of unchecked dominance is over. If your pricing power is broken by Canva's free tools and Figma's collaboration, and your AI server costs keep climbing, your margins will inevitably shrink.
So the earnings part of the price-to-earnings ratio just falls off a cliff.
Exactly.
But to balance the scales here, because we have to represent both sides, the bulls are looking at the exact same dashboard and seeing a resilient powerhouse. Adobe is a cash machine. The reports note they are the only GAAP profitable company in their direct peer group.
Yes, that is a huge point.
Let's define GAAP quickly for the listeners. It stands for Generally Accepted Accounting Principles. It basically means when you use strict standardized accounting rules rather than adjusted make-believe metrics that ignore certain costs. Adobe is the only one in its class actually turning a real undeniable profit. They are generating $9 billion in free cash flow every single year.
And you really have to consider the switching costs in the enterprise world. PDFs, PSD files, Illustrator files, these are the ingrained global standards.
Right.
You simply cannot rip Adobe out of the Fortune 500 workflow overnight without causing massive corporate chaos. Entire supply chains of creative agencies, printers, and marketing departments rely on these specific file formats interacting flawlessly.
Yeah, that inertia is a powerful moat all on its own. Which brings us back to the leadership wildcard. Navigating a threat this existential requires visionary, stable leadership. Can a new, unproven executive team thread the needle between protecting those cash cow legacy products and aggressively cannibalizing themselves with AI to stay relevant?
This raises an important question because that is the defining question for the company moving forward. They are attempting this pivot while replacing their CEO and CFO, creating a strategic vacuum exactly when they need a steady hand the most.
So Adobe is standing at the most critical crossroads in its entire history. On one side, you have an unbelievably cheap cash generator, armed with a legally safe, copyright-protected AI engine, buying back its own stock by the billions.
Right.
On the other side, you have a legacy monopoly, watching its protective moat get systematically filled in by cheaper, faster competitors struggling to grow organically and risking its world-class profit margins to stay in the AI race.
The outcome will dictate not just the future of Adobe, but how the market values legacy software companies in the age of generative AI entirely.
It's fascinating. I want to leave you with a broader thought to ponder, something to just mull over that builds on everything we've discussed today. As artificial intelligence continues to automate the actual work of design, the resizing, the color correction, the layout generation, the routing for approvals, will professional software companies like Adobe remain the indispensable hands-on tools we use every single day?
It's a great question.
Or, as AI takes over the execution, will these complex platforms eventually become invisible utility pipes that just process our text requests in the background? And if the software becomes invisible, how much is that invisible pipe really worth? Are you willing to pay a premium subscription just to talk to an AI? Think back to our opening. The dashboard says everything is fine, revenue is up, cash is flowing. But the passengers are looking out the window at an AI landscape that is changing faster than anyone predicted, and they're reaching for the parachutes. Which one is right? Only time will tell. Thank you for joining us on this deep dive. Keep questioning the consensus, keep looking past the obvious metrics, and most importantly, stay curious.